Welcome to the Deep Dive. We're here to cut through the noise and really explore the essential insights from the sources you've been sharing with us. And today, we're diving into something truly fascinating, I think. The often complex, sometimes confusing world of option strategies. It's interesting, there's this idea in behavioral finance about why winning feels so addictive. It's a bit like buying a lottery ticket, isn't it?
Yeah.
That reflexive part of our brain, the quick, intuitive bit, it just pushes us towards the thrill of a potential big win. Even when, the analytical part, the reflective brain, knows the odds probably aren't great.
Yeah, and that applies so directly to options trading. It's striking, especially for newer traders, right? They often fall into that trap, treating options like a sort of lottery. You hear that phrase, limited risk, unlimited profit potential, thrown around a lot. But well, as one of our sources puts it quite well, trading options blindly without any real strategy, that can quickly become a dangerous but irresistible pastime.
Exactly. So that's our mission today. We want to unpack the mechanics, the science behind options, help you structure a kind of learning path, and really show you how to approach trading options the right way. Look, you don't need to know all, 475 strategies out there. That's just overwhelming. Our goal is to equip you with a handful of really powerful ones, understand them deeply, and maybe more importantly, know how to pick the right strategy for the right market conditions. Think of it like driving a car. Used properly, it's an amazing tool. But if you're rash, well, it can be dangerous.
And that really raises the key question, doesn't it? How do you map the market state, bullish, bearish, neutral, volatile, quiet? How do you map that to the right strategy from your, let's say, your quiver? That's exactly what we're going to explore, making sure you understand not just what to do, but why it matters, and what the implications are for your own approach to the markets.
Okay, let's kick things off. Let's explore some strategies for when you're feeling, let's say, moderately bullish. So you expect to move up, but maybe not, a massive surge. All right, first up, a real classic, the bull call spread. Imagine you're looking at a stock, maybe Reliance Industries. You think it might get a bump after good earnings, but you're not expecting it to shoot for the moon, maybe because some good news is already priced in.
Right. Or maybe a different scenario. A stock hits a 52-week low. It's near some long-term support. You might see a relief rally coming.
Yeah, but you're not totally convinced the whole downtrend is over. That's that moderately bullish feeling.
And to put some numbers on moderate, one source suggests looking at volatility. Maybe expecting a 5 to 8% move for volatile stocks, or less, sub 5% for indices or less jumpy stocks. That kind of thinking really helps when you're picking your strike prices.
Okay, so how do you actually set this bull call spread up? It's a two-leg strategy, pretty straightforward. You buy one ATM call option, ATM meaning at the money, strike price, close to the current price. And at the same time, you sell one OTM call option. OTM is out of the money, strike price above the current price.
And crucially, same underlying asset, same expiry date, same number of options for both legs. The mechanics are quite neat. Let's use the source's nifty example. Spot price is 7,846. You buy the 7,800 call option, maybe it costs Rs 79. And you sell the 7,900 call option, maybe you get Rs 25 for it.
Okay.
So the net effect is you pay money. It's a net debit of Rs 54, 79 minus 25. And here's the beauty. Your maximum loss, it's capped right there at that Rs 54 debit. Doesn't matter how far the market falls.
Right, risk is defined.
Exactly. And your maximum profit is also capped. It's the difference between the strikes, the spread, minus that net debit. So here it's 7,900 minus 7,800, which is 100, minus the 54 debit. That gives you a max profit of Rs 46.
Okay, and the break even. Where do you start making money?
That's the lower strike plus the net debit. So 7,800 plus 54 equals 7,854. Above that, you're in profit, up to that max gain.
So the obvious question, why would you cap your profits like that? It feels a bit counterintuitive, right? Limit your potential winnings.
Well, the main reason, the really strategic one, is the reduced cost of the strategy. Instead of paying the full R79 for just buying the 7,800 call outright, you only pay Rs 54 for the spread. Selling that higher strike call helps finance the one you bought.
So it's a trade-off. You give up some potential upside for a lower entry cost, and crucially, that defined limited downside risk. It's about capital efficiency too.
And strike selection here is critical. The source brings up theta, time decay, that constant erosion of an option's value as time passes.
Always working against the option buyer.
Generally, yes. So for instance, if it's early in the expiry cycle and you expect a quick, moderate move, maybe in 5 days, maybe slightly OTM strikes work. But if you think the move will happen closer to the expiry date, ATM options often give a better balance.
And wider spreads. Like selling an 8,000 call instead of 7,900.
Wider spreads mean potentially higher profit, sure, but they also push your break-even point further out. Need a bigger move.
Okay, that makes sense. Now, what if you're still moderately bullish, but you'd rather receive money up front instead of paying it?
Then you'd look at the bull-put spread. It actually has a very similar payoff shape to the bull-call spread, that capped risk, capped reward profile, but you use put options, and the key difference is you usually get a net credit when you put the trade on.
Okay, so when would this be better?
It can be particularly good when the market's already fallen a bit. Put premiums might be higher because volatility's picked up, and if there's still plenty of time until expiry, you collect that premium up front, basically betting the market won't fall below a certain level.
And the setup is different, right, with puts?
Yes, it's kind of the inverse logic. You buy one OTM put option strike below the current price, and you sell one ITM put option strike above the current price.
So let's use the example. Nifty at 78.05. You might buy the 7,700 put for, say, R72, and sell the 7,900 put for Rs163.
Exactly. And in that case, you receive more than you pay out. You get a net credit of plus 91, 163 minus 72. Your maximum profit is capped right there at that Rs91 credit.
And the maximum loss?
That's the spread width minus the credit. So 7,900, 7,700 is 200. Minus the 91 credit gives you a max loss of Rs109.
Okay. And the break-even?
It's the higher strike minus the net credit. So 7,900 minus 91, which is 7,809. Below that, you start losing down to that max loss.
So, okay, we have the bull call spread, net debit, and the bull put spread, net credit. Both for a moderately bullish view, both capping risk and reward.
Precisely. The choice between them often just boils down to which options, calls, or puts have more attractive premiums at that moment. And, well, your preference payout or taking cash up front, it's about tailoring it to the situation.
All right, let's shift gears. What if your view isn't just moderate? What if you're outrightly bullish? You're convinced the market's going to make a really significant move up.
Right. This is where strategies with potentially uncapped profit start to look interesting.
And here's one that's quite fascinating in its structure, the call ratio back spread. This one offers potentially unlimited profit if the market really takes off upwards, but interestingly, it can also give you a small limited profit if the market actually goes down against your main view. And then there's a specific point of maximum loss if it just stays flat or range bound. It's quite dynamic.
Yeah, it is. And it's usually set up for a net credit too, so you receive money when you initiate it. The classic setup is a 2-to-1 ratio. You sell one ITM call option.
In the money, strike below current price.
Right. And you buy two OTM call options out of the money, stripes above current price.
Okay, let's use the source's Nifty example again. Nifty's at 7743. You sell one lot of the 7600 call, maybe get Rs201 for it, and you buy two lots of the 7800 call at Rs78 each. So that's Rs156 you pay out.
Correct. So the net result is 201 received minus 156 paid equals a net credit of Rs45. And the payoff, as you said, is versatile. Market surges up. Those two long calls take over. Profit is unlimited. Market drops. Both your short call and your long calls expire worthless, but you keep that initial Rs45 credit. That's your profit on the downside.
But there's a catch if it stays flat.
Exactly. There's a sort of danger zone. The maximum loss usually happens right around the higher strike you bought, the 7,800 strike in this case. Here, the maximum loss would be Rs155.
And it has two break-even points.
Yes. One on the lower side, which is the lower strike plus the net credit, 7,600 plus 45, 7,645. And one on the upper side, which is a bit more complex to calculate, but in this example, it's 7,955. Between 7,645 and 7,955, you're losing money, hitting that max loss at 7,800.
That brings up volatility again. How does that play in here? This seems like a bet on a big move.
It is, and the source points out something interesting. If you have plenty of time until expiry, rising volatility is generally good for this strategy. It helps those long calls. But perhaps surprisingly, if you're very close to expiry, a sudden spike in volatility can actually hurt the position.
That's a nuance to keep in mind for a directional bet like this.
Oh.
Okay, now there's another one, the bear call ladder. And the name is tricky, right? Because it's actually another outright bullish strategy.
Russ, don't let bear in the name confuse you here. It's an improvisation on the call ratio back spread. Sometimes it can offer an even better initial credit. The typical setup is a 1-to-1-to-1 ratio. You sell one ITM call buy one ATM call and buy one OTM call.
All right. Using the Nifty example at 7790, sell the 7600 call ITM for Rs 247, buy the 7800 call ATM for Rs 117, and buy the 7900 call OTM for Rs 70.
Okay, so net credit calculation. 247 received, minus 117 paid, minus 70 paid. That gives a net credit of Rs 60, higher than the backspread example.
And the payoff profile. Similar idea.
Very similar. Unlimited profit if the market really flies upwards. And you still keep that initial credit, Rs 60 here, if the market falls instead. But again, there's a difference in the risk, particularly the maximum loss zone. This one also has two break-even points. Lower one at 76.60, upper one at 80.40 in this case. The maximum loss occurs between the two calls you buy, the ATM and OTM strikes, so between 7,800 and 7,900 here, and the max loss is Rs 140 in this example. So again, you get hit badly if the market just stalls right in that zone.
So what's the takeaway for someone considering this? When would you use it?
Well, the source suggests you really need strong conviction for a big move, ideally up for that unlimited profit. It's often considered for individual stocks right before something like quarterly results where a big swing is expected.
And volatility impact, same as the back spread.
Pretty much the same dynamics. Good if it rises when there's time left, less helpful or even negative near expiry.
Okay, let's talk about versatility. Options can apparently replicate almost any payoff, even something like a basic long futures position.
That's right. A synthetic long position does exactly that. It mimics the linear payoff of just being long futures. Market goes up, you make money. Market goes down, you lose money. Pretty much point for point around a break even. And the setup is surprisingly simple for that. Very simple. You just buy the ATM call option and sell the ATM put option. Same underlying, same expiry. So Nifty at 7389 example, you buy the 7400 call for, say, Rs 107, and you sell the 7400 put for Rs 80.
Okay, so this time you pay more than you receive.
Right. It's a net cash outflow of Rs 27, 107 minus 80. The break-even point is the ATM strike plus that net outflow. So 7400 plus 27 equals 7427.
And the payoff is linear, like futures.
Exactly, symmetric. If Nifty ends 200 points above 7427, you make roughly 200 points profit. If it ends 200 points below, you lose roughly 200 points. That's the linear nature.
Now, the big question, why bother replicating futures with options if you can just trade futures? This leads us to that really alluring concept, doesn't it? Arbitrage.
Yes, arbitrage. The idea of risk-free profit. Buying something cheap in one place and selling it higher somewhere else, instantly locking in the difference. The source uses that nice, simple fish market example. Buy fish locally for Rs 100, sell it in the next town for Rs 150. Seems like an easy Rs 50 profit, right? Minus transport costs, of course.
But, and this is crucial, the source points out all the hidden risks, the catches. What if there's no fish to buy? Opportunity risk. What if no one wants your fish in the other town? Liquidity risk.
Right.
What if you're a bad bargainer? Execution risk. Transport costs go up. Transaction costs.
And the big one?
Competition. If it's such a great deal, other people will jump in and that price difference will just disappear. Markets tend towards efficiency.
Exactly. Now, how does this apply to options? Well, there's a fundamental theory called put-call parity. It basically states that a specific combination of options and the underlying or futures should have a fixed relationship, specifically a synthetic long position, long ATM call, short ATM put, plus a short futures position should, in theory, have a zero profit or loss at expiry.
So if it doesn't equal zero.
Then you've potentially found an arbitrage opportunity. The source gives an example. Nifty spot 7304, futures 7316. You go long the 72300 call at 79.5, short the 7300 put at 73.85, and short the Nifty future at 7316. You run the numbers, and no matter where Nifty expires, that combination locks in a guaranteed profit of plus 10.35 points.
Sounds great. Free money. But there's always a but.
The big but is transaction costs. Brokerage fees, securities transaction tax, STT, exchange fees, other taxes. These can eat up those small guaranteed profits very quickly. STT on options, especially ITM ones expiring, can be quite hefty, as the source notes.
So you really have to calculate if the potential profit after all those costs makes it worthwhile.
Precisely. For most retail traders, the edge is usually too small once costs are factored in. True arbitrage is mainly the domain of high-frequency trading firms with minimal costs.
Okay, so we've covered moderately bullish and outright bullish. Now let's look at the flip side strategies for when you expect the market to go down. And professionals, as you mentioned, often like spreads here too for that risk visibility, knowing your max loss up front.
Absolutely. And the direct counterpart to the bull call spread is the bear put spread. You use this when your outlook is moderately bearish. You expect to drop maybe 4 or 5%, but not necessarily a full-blown crash.
And the setup for this, for a sort of standard approach.
You'd buy an ITM put option. That's a put with a strike above the current market price. And you sell an OTM put option. Strike below the current market price.
Okay, example time. Nifty at 74.85. You buy the 7,600 put ITM for, say, Rs 165, and sell the 7,400 put OTM for Rs 73.
Right. Again, you're paying more than you receive. This results in a net debit of Rs 92, 165 minus 73. Your maximum loss is capped right there at that Rs 92 debit. Your maximum profit is the spread with minus the debit. So 7,600, 7,400 is 200 minus the 92 debit equals max profit of Rs 108.
And the break-in point.
It's the higher strike minus the net debit. So 7,600 minus 92 equals 7,508. Below that point, you start making profit, down to that max profit level.
And the source mentions using delta again to confirm the bias.
Yes, delta is really useful for that. For a bear put spread, the overall position delta will be negative. The example given is minus 0.276, clearly showing it benefits from downward movement.
And volatility. When is this best used?
Similar logic to the bull spread. Strike choice depends on time left. And it tends to perform better if you expect volatility to increase, especially in the second half of the expiry cycle.
Okay, now the mirror image again. If you want a net credit strategy for a moderately bearish view, you'd use the bear call spread, right?
Exactly. This is the counterpart to the bear put spread, but using call options. And the key differentiator, as you said, is it's typically done for a net credit. This makes it appealing after a market rally when call option premiums might be inflated and you think things are due for a pullback. You collect cash up front, betting the market won't rally above a certain point.
And the setup here. Using calls for a bearish view.
You buy one OTM call option, strike above current price, and sell one ITM call option, strike below current price.
Let's see the example. Nifty at 72 down 2. You buy the 7,400 call OTM for Rs 38, and you sell the 7,100 call ITM for Rs 136.
Perfect. So 136 received minus 38 paid gives you a net credit of plus 98. That credit is your maximum possible profit, capped at Rs 98.
And the maximum loss.
It's the spread width minus the credit. So 7,400, 7,100 is 300, minus the 98 credit equals max loss of Rs 202.
Rate gamers.
Lower strike plus the net credit, 7,100 plus 98 equals 7,198. Above that point, you start losing money, up to that maximum loss.
And delta confirms the bearishness again.
Yep. The overall delta will be negative, like negative 0.57 in the example, showing it profits as the underlying falls.
And same advice on volatility. Use it when you expect vol to increase.
Yes, particularly in the latter half of the series. Rising volatility tends to help these credit spreads when they are initially set up this way. Now, if you're not just moderately bearish, but outrightly bearish, you think there's potential for a significant drop. Then you look at the put ratio back spread.
The bearish version of the call ratio back spread we discussed earlier.
Precisely. Unlimited profit potential if the market crashes down. Limited profit if it unexpectedly moves up. And a defined maximum loss if it stays in a certain range.
And the setup is the mirror image too, a 2-to-1 ratio with puts.
That's right. You sell one ITM put option and buy two OTM put options. And again, usually done for a net credit. Let's use the nifty 7506 example. Sell one lot of the 7500 put ITM for Rs 134. Buy two lots of the 7200 put OTM for Rs 46 each. That's Rs 92 paid out.
Okay, so 134 received minus 92 paid gives a net credit of Rs 42.
Correct. Payoff. If the market tanks, those two long puts drive unlimited profit. If the market unexpectedly rallies, all puts expire worthless, you keep the Rs 42 credit.
And the max loss point
occurs at the lower strike price, the 7,200 level here. That's where things can go badly against you. Max loss is Rs 258 in this case.
with two break fins again.
Yes. An upper one calculated as 7,458 and a lower one calculated as 6,942. Between those points lies the loss zone.
Delta here still indicates bearishness.
Yes, even if it's small, like a Nefical 0.03 in the example, it shows sensitivity to downward moves.
And volatility. Helpful again.
Especially with time on your side, rising volatility can significantly boost the potential payoff of those two long puts.
Okay, we've covered strategies for clear directional views, up or down, moderate or strong. But what about that very common situation where you put on a trade and the market just does the opposite, or worse, just flatlines?
Ah, yes. The frustration of a sideways market when you've bet on direction. This leads us perfectly into market-neutral strategies, sometimes called delta-neutral. With these, profitability doesn't depend on which way the market goes, but rather on how much it moves or sometimes how much it doesn't move.
And the simplest one is probably the long straddle, right?
Yeah, that's the classic starting point. It's incredibly simple to set up. You just buy an ATM call option and buy an ATM put option. Same underlying, same strike price, the ATM one, same expiry date. Let's take Nifty at 75579. ATM strike might be 7,600. So you buy the 7,600 call, maybe for Rs 77, and you buy the 7,600 put, maybe for Rs 88.
Okay, so you're paying out for both.
Right. Total cost, the net debit, is Rs 165, 77 plus 88. This creates that distinctive V-shaped payoff graph. Your maximum loss is strictly limited to that Rs 165 premium you paid. That happens only if the market expires exactly at the 7,600 strike.
Both the upside.
Unlimited profit potential in either direction. If the market makes a big move, up or down, one of your options becomes very valuable.
And the break-evens, there must be two.
Yes, they're equidistant from the ATM strike. The upper break-even is ATM strike plus net premium. So 7,600 plus 165 equals 7,765. The lower break-even is ATM strike net premium. So 7,600, 165 equals 7,435. You need the market to move beyond these points to profit.
So what's the core idea here? Direction is irrelevant.
Correct.
But volatility, the size of the move, is everything.
Absolutely. And what's really key to grasp is that the cost of this strategy, that net debit, goes up significantly when implied volatility is high. People expect a big move, so they bid up the price of both calls and puts. And this means the ideal time to put on a long straddle is when volatility is relatively low, but you expect it to increase sharply, causing a big price swing.
Okay, it sounds fantastic on the surface, doesn't it? Unlimited profit, limited loss, direction doesn't matter. What's the catch? What can go wrong?
Well, two big things. First, theta decay. Time decay. Options lose value every single day, and that decay accelerates as expiry gets closer, especially for these ATM options if the market doesn't move. You're fighting against time.
Right, it's a wasting asset.
Exactly. Second, look at those break-even points. They can be quite far away. In our Nifty example, the market needed to move over 165 points, which is about 2.2%, either way, just to break even.
And that move needs to happen before expiry.
And ideally quickly, before theta eats away too much premium. Expecting moves of that size regularly within the option's lifespan is often the main challenge. So connecting it to real-world events. Long straddles can work around things like earnings announcements, yes, but typically only if the result is a huge surprise, something drastically different from what the market was expecting.
Because if the result is expected.
Then volatility often collapses after the announcement. People were paying up for the uncertainty is resolved, vol drops, and the premiums on your straddle just evaporate. Even if the price moved a bit, you can lose money even if you got the direction right eventually.
So the ideal scenario is low vol when you buy, vol spikes up, and you get a large quick move. Lots needs to go right. Given those challenges, this is where the flip side becomes interesting, right? The short straddle often seems more appealing to seasoned traders.
Yes, for many it's a more practical approach, though it comes with its own significant risks. Instead of buying, you sell the ATM call and sell the ATM put. So now you receive a net credit up front. Using the same numbers, selling the 7,600 call for 77 and the 7,600 put for 88 gives you Rs 165 in your account. The payoff graph is the exact opposite, an inverted V shape. Your maximum profit is limited to that net credit you received, the Rs 165. And you achieve that maximum profit if the market expires exactly at the ATM strike, 7,600. Basically, if the market doesn't move at all.
But the risk?
The risk is the flip side, too. Your losses are potentially unlimited if the market makes a huge move in either direction, far beyond your break-even points.
And the break-evens are the same points as the long straddle.
Exactly the same. Upper at 7,765, lower at 7,435. Outside that range, the short straddle starts losing money, potentially a lot of money.
So the implication is clear. A short straddle works best when you expect things to be calm, when you expect the market to stay within a fairly narrow range.
And the source provides a great real-world example with Infosys earnings. Before the results, uncertainty is high, so implied volatility and option premiums are inflated. The trader sold the 1140 straddle, call and put, 4 days before the event, collecting a hefty Rs 95 premium.
Okay.
After the announcement, the market reaction was pretty much in line with expectations. What happened to volatility?
Dropped. Crashed, probably.
Exactly. Volatility collapsed. So the trader could buy back the same straddle shortly after the announcement for much less, locking in a 20-point profit per lot. The key wasn't predicting the price, it was predicting the volatility drop, because the outcome wasn't a huge surprise.
And like the long straddle, the short straddle is delta neutral at initiation. Zero directional bias.
Correct. Combined delta is zero. It's not a bet on direction.
So ideal conditions. High vol, when you sell, you expect vol to decrease. You expect the market to stay put within that break-even range. Okay, straddles make sense. Now, what about strangles? They sound similar.
They are very similar. Think of them as straddle's cheaper cousins or maybe wider cousins. A strangle is designed primarily to reduce the initial cost for a long strangle or collect less premium but get a wider profit zone for a short strangle. Instead of using ATM options, a strangle uses OTM out of the money options. You use an OTM call and an OTM put, usually equidistant from the current ATM strike.
So for a long strangle.
You buy the OTM call and buy the OTM put. Because OTM options are cheaper than ATM ones, your initial net debit is lower. The nifty example shows maybe R60 debit for a strangle versus Rs 123 for the straddle.
What's the trade-off for that lower cost?
Your break-even points are pushed further out. The market needs an even larger move than with a straddle just to become profitable. Profit potential is still unlimited, though.
Okay, and the short strangle.
You sell the OTM call and sell the OTM put. Because you're selling cheaper OTM options, your net credit received is smaller. Example, Rs60 versus Rs 123. But the benefit is that the range between your break-even points, the range where you make maximum profit, is wider than with a short straddle. Gives you more room for error if the market does move a bit. Losses are still potentially unlimited, though.
So the key takeaway, strangles are also delta neutral, bets on volatility or lack thereof.
Correct. The long strangle likes the same conditions as a long straddle. Low vol entry, expecting vol to rise, expecting a big move, maybe around an uncertain event, just needs a bigger move to pay off.
And the short strangle.
The short strangle with that wider profit zone but smaller credit is really good when you expect the market to stay contained within a pretty well-defined trading range. The source specifically suggests looking for stocks stuck in ranges, maybe hitting the same highs and lows repeatedly. You could then sell strangle strikes outside that known range, but you absolutely have to be vigilant for a breakout or breakdown from that range.
All right, moving beyond specific strategies now. There are some broader theories and indicators people use to try and gauge overall market sentiment, or even predict where the market might end up on expiry day.
Yes, a couple of interesting ones mentioned in the sources. One is quite controversial but has a dedicated following. Max Pain, also known as option pain. It's based on this observation or belief that a huge percentage of options, maybe 90%, expire worthless, which implies that option sellers, the writers, tend to make money more consistently than option buyers over the long run.
Okay, so if sellers usually win.
The theory suggests that on expiry day, the price of the underlying asset will somehow be pinned or gravitate towards the strike price that causes the least amount of financial loss to the largest number of option writers collectively.
Least pain for the sellers.
Exactly. Which, by definition, means that strike price causes the maximum pain for the option buyers as more of their options expire worthless at that specific point.
It almost sounds like market manipulation, like big players push the price there.
That's the controversial part. Whether it's active manipulation or just the sheer weight of open interest creating pressure is debated. But the theory focuses on finding that least pain point for writers. How do they calculate it? Well, you list all the strikes with significant open interest. Then you calculate for each strike price what the total payout from writers the buyers would be if the market expired exactly at that strike. You sum up the losses for all call writers and all put writers at that assumed expiry price. You do this calculation for every single potential expiry strike. The strike price where that total calculated loss for writers is the lowest is deemed the max pain point.
The source had an example, like 7,800 being max pain if that resulted in the lowest payout from writers.
Yes, that's the idea.
And how do traders use this? If 7,800 is max pain, what do they do?
Well, some might use it to decide where to write options themselves. They might sell calls with strikes above 7,800 or sell puts with strikes below 7,800, betting the market will indeed settle near that max pain level, making those OTM options likely to expire worthless. But, and this is a big but, the source itself mentions having initial frustration with max pain's accuracy. It wasn't always reliable as a single pinpoint prediction.
So they suggested modifications.
Yes, a couple of practical tweaks. First, don't use real-time open interest data right up to expiry. Freeze the OI data maybe 15 days before expiry, arguing that gives a more stable picture of where the big positions are. Second, don't treat the calculated max pain number as exact. Add a kind of safety buffer around it, maybe plus or minus 5%.
Which corresponds to what statistically?
Often about 1.5 to 2 standard deviations. This creates a more probable expiry range rather than a single point, which apparently increases the success rate significantly.
Interesting. Any other advice on using it?
One more point from the source. They suggested generally avoiding writing put options based on max pain. The reasoning was panic spreads faster than greed. Markets tend to crash downwards much faster and more violently than they grind upwards. So writing puts feels inherently riskier.
Okay, max pain is one tool. What about the foot call ratio, PCR? That sounds simpler.
Much simpler, yes, but still a powerful gauge of sentiment. It's literally just the total open interest of put options divided by the total open interest of call options across the market or for a specific stock.
Open interest being the number of contracts still open, not yet closed or expired.
Exactly. And the value usually fluctuates somewhere around 1.0.
So how do you interpret the PCR? What does it tell you?
It's primarily used as a contrarian indicator. If the PCR gets really high, say above 1.3, it suggests extreme bearishness.
Yeah.
Far more puts are open than calls. The contrarian view is that if everyone is already bearish and positioned for a fall, the market might be oversold and due for a bounce or reversal upwards.
Okay. And the opposite, if PCR is very low.
If it drops below 0.5, that suggests extreme bullishness. Loads more calls open than puts. The contrarian take is the market might be overbought, too euphoric, and potentially due for a pullback or correction.
In values between 0.5 and 1.3.
Generally considered more neutral or normal market activity, not signaling an extreme sentiment level. Why contrarian? The thinking is, if sentiment reaches an extreme, like very high PCR, most people who wanted to bet on a decline, buy puts or sell calls, have probably already done so. There are fewer bears left to push prices lower. This can lead to short covering or profit taking, causing a reversal. It tells you, be wary of following the herd when sentiment gets too one-sided.
So to use it effectively.
The source wisely recommends not just relying on generic levels like 1.3 or 0.5. Instead, plot the historical PCR values for the specific asset you're trading. See what its historical highs and lows are. That gives you a much better context for identifying true sentiment extremes for that particular stock or index.
Wow. Okay, we have covered a lot of ground there. From the basic building blocks of spreads for moderate views, all the way to ratio spreads for strong conviction, market-neutral straddles and strangles, and even these sentiment tools like max pain and PCR. It's a comprehensive toolkit.
It really is. And remember, we've probably touched on, maybe 15 different strategies or concepts here? That's way more than the handful you probably need to truly master to be effective. The key isn't knowing every single variation. It's deeply understanding the mechanics of a core few. And crucially, developing that instinct for when and why to apply a particular strategy based on your read of the market.
Yeah, it comes back to that car analogy we started with, doesn't it?
Yeah.
These strategies are powerful tools. Use them right, with discipline, with a good understanding of the road conditions, the market conditions, they can really work for you. But yeah, if you're reckless, if you misjudge things, they can definitely create a hole in your P&L, as the source puts it.
It absolutely depends on your discipline and your reading of the markets. There's no magic formula. Your skill in applying these strategies will genuinely improve as you spend more, let's call it quality time in the markets, observing, learning, testing, refining your approach. It's a continuous process.
And it really brings us to a final thought, something for you, our listener, to chew on. Given everything we've talked about, how market events, time, volatility, psychology, all intertwine with these complex option strategies. What often overlooked factor, something perhaps beyond just picking the technically right strategy on paper, do you think has the most subtle, yet maybe the most significant impact on a trader's long-term profitability in this game? Thanks so much for joining us for this deep dive into the world of option strategies. We really hope this has provided a clear, practical roadmap for better understanding and maybe even starting to master this exciting, dynamic part of the financial markets. Until next time.